Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing ADMA Biologics stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. ADMA Biologics is a biopharmaceutical company dedicated to manufacturing, marketing, and developing specialty plasma-derived biologics for the treatment of patients with weak immune systems. The company is headquartered in Ramsey, New Jersey, and was founded in 2004. It went public in 2013 and currently trades on the NASDAQ. Its biocenters are FDA licensed facilities specializing in the collection of human plasma used to make special medications for treatment and prevention of diseases. The company currently manufactures and markets 3 FDA-approved plasma-derived biologics. Many of the medicines we take try to fight the disease, but also weaken our immune system. ADMA's goal is to strengthen your immune system. Let's get started with the model. This is a micro-cap company, 224 million market cap. They're trading at $237 a share, and they have 95 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have negative net income every year. Revenue is the sales for the company. That's pretty low. It goes from 23 million up to 40 million. This is the company's income statement. You can see in Yahoo Finance their trailing 12 months equals 2019. I had to manually calculate their trailing 12-month financials. That's why it's on my spreadsheet. The top line of their income statement is their revenue. Below that is the cost of revenue. Then the difference is their gross profit. They have negative gross profit because their sales aren't too high yet. Once their products become popular and part of the mainstream, then the sales can go through the roof. But it can take a really long time for that to occur. Below gross profit is operating expenses and then their operating income. And they have negative operating income every year. Then there's the interest they pay in their debt, other income and expenses. The bottom line of the income statement is their net income, which is negative every year due to low sales. This is the statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they have negative free cash flow every year. In order to run their business, they need to take on capital stock and issue debt. They took on 39 million of capital stock in 2017, 43 million in 2018, and 48 million in 2019. When a company issues capital stock, it increases the shares outstanding, making your shares less valuable. In 2017, 18, and 19, they issued about $120 million of debt and paid down about $86 million of debt. So they're also using some debt to run their business. Let's look at the capital structure. $71 million of equity, $100 million of debt. They're 42% equity, 58% debt. Their WACC is 13.4%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 680 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $362 million. We divide that by 95 million shares. And we get a calculated stock price of $383. They're trading at $237, so they're trading at a 38% discount. It's a buy according to the model. Simply Wall Street is much higher than me. They're at $18 a share, so they're saying the stock is really undervalued. I used analyst estimates to try to predict their future free cash flows because their past free cash flows were negative, so I can't use their past. I also looked through their financials and looked at their competitors' financials. If their drugs are really successful, they can have massive free cash flow. Of course, things aren't always that easy. There's competition and there's always hiccups in the road. But you have to remember, the stock price is not always based off of how well a company's doing. It's based off of supply and demand of the market. If the market feels the future of this company is going to be strong, they'll bid the stock price higher before they start generating positive free cash flow. And if they think the company will be struggling in the future, they'll bid the price lower, even if they start generating positive free cash flow. This is the stock price the last 5 years, so it looks like it's pretty much only gone down. It peaked about $8 in 2016, but it's been going down little by little over the years. And they have a beta of 1.7, so the stock moves a little less than 2 times the market. The stock has gone down 30% in the past 52 weeks, while the S&P 500 went up 24%. The 52-week low was $1.45, the high was $4.20. And the stock is trading above its 200-day, but below its 50-day moving average. About 2.5 to 4 million shares are traded each day on this stock. Of the 95 million shares outstanding, 76 million are on float, 55% are held by institutions, and 12% of the shares on float are shorted. So it has a pretty high short percentage. If you invested $10,000 into this company in 2013 when it IPO'd, you'd be at $2,800 today. That's a 16% annual loss. The biggest shareholder is Perceptive Advisors at 17.5%, then BlackRock, Vanguard, Iceland Capital, and Marshall Wallace. Let's look at their financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. When a company has negative PE, you look to the price to sales ratio. Price to sales is stock price over sales per share. They're at 5.6. So that's between the median and average. That means investors are paying $5.60 for $1 revenue. Price to book is stock price over book value per share. They're at 3.1. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 71 million of equity, 65 million of tangible equity, since they have 6 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity, negative net income, negative ROE. Current ratio is current assets over current liabilities. They can easily cover their current liabilities with their current assets. Their current assets are 60 million of cash and 70 million of inventory. The company does have $123 million of working capital. Working capital is current assets minus current liabilities, but they did have negative $100 million of free cash flow. So if they have a similar amount of free cash flow in 2021, they're going to be really close to needing more debt or equity to run their business. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 10 other companies, and ADMA is right here. If they have a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in all the price multiples, only because this industry has pretty weak ratios. They have a really high current ratio, much higher than the average. They're much worse than average in ROE, debt, and they're a really small company at 224 million market cap. Average is 25 billion. So to summarize, I have them trading at a 38% discount. A lot of times when you invest in companies in the medical field, you have to wait a really long time for them to turn a profit. So sometimes you're just sitting on the investment for years or decades, and it may never turn into anything, or it may be a big hit, but you don't know when. This company does have a lot of exciting products on the horizon, and it looks like they're going to do some great things, but only time will tell. I rank their free cash flows 1 out of 10, I rank their revenue 2 out of 10, and I rank their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.